NVIDIA just reported $81.6 billion in revenue for a single quarter. Yet, following this massive earnings print, the stock sharply sold off. This dual-axis chart illustrates the disconnect. We are looking at an 85% year-over-year revenue surge, colliding directly with a downward trend in price action. To put that operational scale into perspective, the company generated $48.55 billion in free cash flow in just 3 months. Despite those massive pillars of cash generation, the stock experienced a technical pullback, hovering in the $215 range. Retail investors often interpret this kind of post-earnings drop as the signal of a market top. The data suggests a different driver. The drawdown was driven by a gamma unwind in the options market. Institutional positioning and hedging adjustments triggered a mechanical liquidity drain. The resulting price action is a byproduct of the derivatives market. It masks the company's true operational momentum. To understand this ceiling on technology valuations right now, we have to look at the broader macroeconomic environment. Under the new central bank leadership, inflation remains deeply sticky, holding firm at 3.8%. Consequently, the 10-year U.S. Treasury yield is currently sitting at 4.56%. Mathematically, this high-yield environment forces a severe compression on the forward valuations of all growth assets. But in zero net debt on their balance sheet. Armed with that cash pile, management has authorized an $80 billion share buyback program, effectively deploying value stock capital return policies. They also initiated a 25-fold increase to their quarterly dividend. The company is operating as a hyper-growth infrastructure asset that is shielded by the defensive fortifications of a mature value stock. Inside the data center segment, the company generated $75.2 billion. Let's break down exactly where that capital is flowing. The market is currently underestimating the firm's secondary growth engine, networking interconnects. Revenue from SpectrumX and NVLink surged 199%, contributing $14.8 billion. That vertical integration translates directly into pricing power. The company's net profit margin stands at 71.45%. Hyperscaler clients are locked into this ecosystem through the CUDA software layer, which integrates perfectly with the physical hardware. Competitor custom silicon, like AMD's ASICs, can only capture market share at the edges of inference. They have struggled to penetrate NVIDIA's position in core model training. With these margins and growth rates locked in, we can examine the actual valuation metrics to test the retail bubble theory. This chart tracks the company's valuation multiples over time. The current forward price-to-earnings ratio has been compressed down to a range between 24 and 26.3 times. For context, the company's historical 5-year average PE sits at 65.8 times. This places the stock in its lowest 5% valuation percentile over a 5-year window. The underlying corporate earnings expansion has vastly outpaced the stock's price appreciation. Mathematically, the asset has already debubbled. Silicon competition is a secondary concern compared to the hard physical limits of the electrical grid. The data center industry is slamming into a constraint known as the power wall. This schematic compares facility requirements. A traditional air-cooled facility maxes out at 50 kilowatts. Next-generation architecture demands a massive liquid cooling loop. A single GB200 NVL72 cabinet requires a staggering 100 to 132 kilowatts to operate. This is an active operational hazard. A major hyperscaler recently suffered an estimated $100 million loss at a facility in Texas. That multi-million-dollar write-down was driven by next-generation server overheating and technical installation failures. Zooming out to a global scale, the electrical infrastructure is struggling to keep pace. There is a physical bottleneck in the manufacturing and deployment of high-voltage grid transformers. Compounding the grid issue is the complex plumbing required inside the servers themselves. The production of blind-mate liquid cooling loops is failing to match the speed of GPU manufacturing. This physical bottleneck creates a structural risk within the $119 billion in total supply-related commitments. If end clients lack the power or the cooling infrastructure to turn the machines on, those commitments will become stagnant inventory. The expansion of the business now depends on the raw capacity of global electrical infrastructure. To model how physical risks and earnings velocity price into the market over the next 12 to 24 months, institutions use a scenario matrix. This matrix maps the probabilities. The bear case sets a price target between $160 and $170. This scenario triggers if the power wall crisis materializes, forcing write-downs on that $119 billion supply chain. Gross margins would crack below 65%, compounded by the 10-year yield breaching 5%. The base percent. Finally, the bull case projects a target of $320 to $350. This outcome requires central banks executing early rate cuts based on AI deflation theories, while software companies prove AI API revenue structurally overtakes hardware depreciation costs. Professional portfolio managers weight these three scenarios to construct positions with asymmetric risk. Translating those probabilities into execution requires absolute discipline, removing retail euphoria from the equation. For current position holders, the rule is to defend 85% of your core position to capture the long-term compounding growth. The dynamic take-profit zone activates only if the price aggressively squeezes into the $236.50 to $260 bracket. At that point, trim 10 to 20%. Simultaneously, set a strict stop-loss on those trading shares at the 50-day moving average of $196. This graphic details the strategy for deploying new capital. We use an inverted pyramid structure. Tranche 1 deploys 30% of your capital at the $210 to $215 range to capture the immediate post-earnings gamma mean reversion. Tranche 2 deploys 40%, exactly at the $196 50-day moving average, absorbing any macro-driven dips. The final 30% is deployed either during extreme panic at the $187 200-day moving average or upon a high-volume breakout above $236.60. The absolute technical escape hatch is a hard stop between $175 and $178. Beyond technicals, there are fundamental invalidation metrics. Liquidate the entire position if quarter-over-quarter data center revenue drops below 0%, or if margins fall below 70% for 2 consecutive quarters. Mastering an asset with this level of volatility requires stripping away the narrative hype and executing purely on rigid mathematical boundaries. To stay ahead of the liquidity cycles and institutional positioning, hit the like button, subscribe, and share. Calling Monster Finance for more deep dive US stock analysis.